Welcome to Asset Documentation, a critical component of the mortgage qualification process. In this video, we'll explore the three key areas that lenders examine when verifying a borrower's financial readiness: seasoning requirements, gift funds, and reserves. Let's start with seasoning requirements. Seasoning refers to the length of time funds have been in a borrower's account. Lenders want to ensure that the money used for down payment and closing costs is legitimate and has been in the borrower's possession for a reasonable period. Typically, lenders require at least 2 months of bank statements to verify seasoning. Any large deposits that appear during this period must be sourced and documented. This means if a borrower suddenly deposits $5,000, they'll need to explain where that money came from. Common sources include the sale of assets, tax refunds, or bonuses from employment. The key is transparency and documentation. Lenders are looking for stability and want to avoid situations where borrowers are taking on additional debt just before closing. Now let's discuss gift funds. Many first-time homebuyers receive financial assistance from family members to help with their down payment. While this is perfectly acceptable, it must be properly documented. The lender will require a gift letter that clearly states the donor's name, relationship to the borrower, the gift amount, and a declaration that the funds are a gift and not a loan that must be repaid. The donor must also provide proof that they have the funds available to give. This typically means providing bank statements showing the withdrawal of the gift amount. The paper trail is essential. The funds must be transferred directly from the donor's account to the borrower's account, and both the withdrawal and deposit must be documented. Gift funds can come from family members, employers, or charitable organizations, but they cannot come from anyone with a financial interest in the transaction, such as the seller or real estate agent. Reserves are another crucial element of asset documentation. Reserves refer to liquid assets that remain after the down payment and closing costs have been paid. Lenders want to see that borrowers have a financial cushion to handle mortgage payments if unexpected expenses arise or income is temporarily interrupted. The amount of reserves required varies by loan type and property type. For a conventional loan on a primary residence, lenders typically want to see at least 2 months of reserves. For investment properties or borrowers with multiple mortgages, the requirement can be significantly higher, sometimes 6 to 12 months. Reserves must be in liquid form, meaning they can be quickly converted to cash. This includes checking accounts, savings accounts, money market accounts, and certain retirement accounts. However, only a portion of retirement account balances may be counted, typically 60 to 70%, to account for potential taxes and penalties on early withdrawal. Stocks and bonds can also count as reserves, but lenders may apply a discount to account for market volatility. In conclusion, proper asset documentation is essential for mortgage approval. Understanding seasoning requirements ensures your funds are properly aged and sourced. Documenting gift funds correctly protects both the borrower and the lender, and maintaining adequate reserves demonstrates financial stability and preparedness. By mastering these 3 areas, loan officers can guide their clients through the documentation process smoothly and increase the likelihood of successful loan approval. Remember, thorough documentation is not just a requirement, it's a protection for everyone involved in the transaction.